Today, all about property portfolios. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to another post covering finance and property news with a distinctively Australian flavour. Today, I'm joined again by Edwin Almeida. Hello, good to see you again.
Great to see you again, Martin.
So your last post worked really well. We had a lot of feedback and I think people liked it. So it's good to catch up again. And this time we're going to delve into a little bit more detail about the fact that not all properties are the same.
Most definitely. I spoke about the grenades that we're sitting on in the previous video. I wrote about it as well. I've also been speaking about, being public about the Blacktown LGI, being the canary in the coal mine, which I think I referred to in the previous video as well. I've looked at Sydney from north, south, east and west and looked at the dwellings. And I guess to give your viewers a better understanding of where I'm coming from and the research and the material that I've gathered over the years and why I've come to these or formed these opinions, I'd like to delve a little bit deeper into my reasoning with regards to property. So you've got the scenario where Sydney, in essence, and a lot of parts of Sydney are very old. Traditionally, they are very old towns that have just merged together over the decades. So we've got a variety of dwellings. We've got the fibro shacks, fibro homes, brick veneer. Now you've got your new subdivisions, you've got your high rise, and you've got your medium density. So in terms of the grenades, which I referred to in the previous video, I guess this is sort of the gunpowder or the powder that's in these grenades. When you look at the dwellings, when you look at the properties, particularly in the outer skirts, the outer suburbs of Sydney, and you look at the composition of what they're made of, they're decaying, they're dilapidating, they are deteriorating.
Right. So many of these were built in the 20s, 30s, 40s and 50s, right?
Exactly.
When presumably the building regs were different. They'll presumably have some suspect construction materials, asbestos and those things in them, and they're getting to the end of their working life.
That's right.
Yeah.
But what's happened is, what we've done in the last 20, 30 years is we've added to these properties. Mm-hmm. We've extended them,
right.
But we've kept the main core, the main structure, where, as you mentioned, you've got asbestos, you've got galvanized piping that's been there from day one, so you don't know what you're drinking when you're drinking the water. You've got the overloaded circuit boards. They become fire hazards. Then because of the nature of the way that we live now, you've now got this surgence of mold, because nobody wants to open windows, nobody wants to ventilate the properties anymore. So we've got this mix. And these properties, Martin, have been selling at the peak of the market in the outer suburbs of the Blacktown LGI, heading closer towards Penrith. They were selling in the $550,000 for your average 520 square metre block of land with these homes on them. As we'd say, the old housing commission homes, the old areas, those old areas.
And were people buying them to knock them down and put up new stuff, or just basically to live in the existing and add a little bit to them?
Just live in the existing homes.
Right.
To just rip the carpet up, polish the timber floors, give it a lick of paint, and whack another tenant in, because it was hard to find accommodation, and tenants, you could find them at the drop of a hat.
Okay.
But things have changed now with this mass oversupply that is just being fueled for the last 5-6 years. It's just been fueled, particularly out in the western regions, southwest, northwest regions, where you've got all these mass subdivisions. So now you've got a choice. As a tenant, you've got a choice. Do I stay in this old derelict fibro shack that people call homes, or do I move to a brand new 3-bedroom, 2-bathroom home in the new subdivisions. So a number of people have said to me, "Oh yeah, but people want to have the space, and they want to have the space for the kids to run around." So I turn around to them and I just say, "When was the last time you mowed your lawns?
Right.
When was the last time you spent a bit of time in the garden?" That mindset has gone. We don't play backyard cricket anymore. We're playing on our laptops or iPads, and if we are playing back, it's usually on an iPhone or an iPad or a smartphone or an iPad. So what they're looking for now is comfort, and in a sense of, well, if I'm going to be paying $400 a week, I might as well get something for it. So you're seeing a massive drop in rents in the older dwellings, and particularly when you've got landlords that haven't been taking care of their properties over the last 5-6 years because of this huge upward trend even in rental values.
Right.
So they've said, well, everybody's happy, I'm happy, I don't have to spend. And unfortunately, a number of my peers haven't kept up to date, haven't kept the landlords up to date with what's being required and needed. So they're basically living somewhat in squalor-like conditions and in dangerous and hazardous situations.
So let me just sort of wind that back slightly, just so people are clear. We're talking predominantly about people who've bought investment properties.
That's correct.
They've tended to buy old investment properties. They haven't done much in the way of improvements. And whilst there are some guidelines about the level of accommodation that should be provided to tenants, in many cases, they're probably not meeting the current standards.
Very much so. They're failing. They're failing in a big way.
And there's no external body, is there, that comes in and checks the standard of investment properties that I know of? Or how does that work?
There are regulations that we...
Yeah, I know there are regulations, but who's...
But no. To answer your question in short, no. We are meant to be the conduit. We are meant to be the voice that stands on behalf of the landlord, stands on behalf of the tenant.
Right.
We are meant to be looking at these things. But unfortunately, my industry has failed, and...
So we've got the situation now, whereas previously there was probably a shortage of accommodation, and so tenants would just grab the first thing that came around. Now they can choose, right?
Definitely.
And as you say, if you're a tenant and you know what you want to spend in terms of rent, and you've got the choice of a brand new shiny property over there or a rather old smelly one over there, you can obviously know which way you're going to go. You're going to go to the more modern one, right?
Exactly.
And in recent times, there's been huge construction in southwestern Sydney. So as well as subdivisions, there's been a whole bunch of high-rise being built as well. So now tenants have the opportunity to be able to grab that more attractive property for rent.
Exactly.
And that means you then left with this supply of second-class property, right, that cannot now command the sorts of rents that it used to, that is still deteriorating, right, and therefore its intrinsic value is now falling.
Definitely.
Right.
And now we've got the effects of that, and over a short period of time. It's not even been 12 months, and values in these areas have gone down 24-27%. I've posted some of these out on in my social media posts. I've tagged you on some of them, and you can see now intrinsically, like we're saying, there is a value to the dwelling itself.
Yep.
But anything that we build is going to deteriorate, and hence the reason why we use the term depreciate. So it's a depreciated value that you claim against your tax and so forth. So these have depreciated. These have now gone beyond depreciation. They've gone into deterioration, and they become very, very hazardous. So now once you take the intrinsic value, because they can still give you or give the owner a rental income. Once let's take the value, I would say most of them would be valued, the actual dwelling itself would be valued anywhere between $75,000 and $100,000 because they are not new. So you can't say that the dwelling is worth $200,000 or $230,000 like you would for a brand new 3-bedroom, modest home.
Right.
So therefore, when you take that away, because it's continuously deteriorating, you take that away and then you're left with the land.
Yep.
It's simple mathematics.
Yep.
How many square meters, how much do you want for your block of land? And there's your value of your property.
So let me sort of tell you how I think about that.
Sure.
So basically, in a rising market, a booming market, you've got price discovery going on all the time, and so basically the prices are up there somewhere.
Yes.
But now you've got to think differently. So you've basically got the cost of the land, right, which is whatever it is, and that will be determined by where it is and all those sorts of things and the size of it. Then you've got a cost of putting something on it.
That's right.
So add on that, and then you've got some sort of amenity value over the top of that based on where it is. If it's got great views or if it's on the coast. But that, if you do that those mathematics, right, quite often you'll find that the difference between that and what people thought it was worth was up to 40% difference.
Very much so.
Right.
Very much so. And then add more fuel to that, and that is the oversupply. Rental yields going down.
Yep.
All those grenades that that I've been talking about for many years now, and you've got a very heavy downward trend.
Right.
Everything.
So have you any idea? I mean, you might not know, but what proportion of property investors then are sitting on these old properties that are really not going to be that valuable and are paying something in the way of rentals, but perhaps not a huge amount? I mean, is it 5% or 20% or 50%? What's the mix?
I think I believe that the mix is going to be probably about 40 to 55%, because I'm also counting in this the old apartments.
Okay.
We've got intrinsic problems with older apartments as well.
Right.
When it comes to wiring, when it comes to safety, when it comes to asbestos. A lot of people don't even know that the old carpet, the underlay, has asbestos, and yet they're living on it.
No. So what we're saying then is around half of property investors, the ones owning those older properties, right, are actually in for an additional shock. Not only have we've got higher interest rates on the mortgage and all the other things that people are aware of, but we've actually got a much more fundamental problem about the quality of those properties and the value of those properties over time.
That's correct.
And ahead, we're going to see those values continue to fall because of the continued dilapidation of those properties.
Very much so. And then legislation is going to come in.
Right.
And it's going to come in like it has in Victoria,
Yep.
where there will be greater controls in order for you to rent a home. You have to meet a higher standard.
Right.
I still don't believe that those standards are high enough, and I still don't believe that that's going to be governed as effectively as I would like for them to be governed. But they're going to come in. It's only just around the corner, so that's going to add more cost to the investor. So what are they going to do?
Right. So do you think the property investment party is over then?
In a lot of areas, yes.
Right.
In a lot of areas, and in a lot of properties, or the type of property.
Yeah, depends on the type, as you said. If it's a new property, might be okay, but of course even there the values of those new properties are also on the slide a bit more. But if you're in an older property, if you have a portfolio of older properties, then you've got some major headaches ahead.
Yeah, well, you've got, and interestingly, this is where I just saw one of the videos from Roger Montgomery a day or two ago, and he said, well, we're going to head into an era where you might as well wait until you see the drops of 40% and then pick something up. So going back to the older homes, and that is like, people have bought them. They have done up the kitchens. They have done up some of the bathrooms. Not all, but some. They've done up the kitchens, bathrooms. They've lifted up the old carpet and they've polished the flooring. They've improved the safety aspects with regard to the electrical wiring and so forth. But there's one thing they can't do is get rid of the old cladding, because that's where all the fibro is, where all the asbestos is.
Yep.
So, but they have improved the dwelling.
All right.
So if you're going to be an investor, my recommendation to a number of investors that have come to me and said, Edwin, I'd like to buy here, I'd like to buy there, and when they give me this smorgasbord of what they believe they want, and I said, well, I've been saying to a number of my clients again, saying, just wait a little bit longer and get somebody else's demise, pick up somebody else's demise, somebody that they've already gone through all that headache. Why go through the headache now? Yep. So we've got this huge shift in mindset now, because we've got a huge shift in price. And why would I want to buy like I sold my nephew's property for $515,000 10, 11 months ago? Why would I want to buy that for $515,000 when now better quality property with added features, with double garages and carports, in some instances swimming pools, I can now get for $425? Not that I would right now. I still think there's a lot more to drop in those areas, but that's what you've got.
Sure. So I don't know whether you've seen it, but I did some research. I have these household surveys running all the time, right? And I actually asked investors what they were thinking of doing over the next 12 months. Right. And if you go back a year, more than half of property investors were looking to buy. Right. Now less than 10% are looking to buy. Most are considering selling. Right. Because the economics for them is not working anymore, right? Because effectively the interest rates on the mortgages are going up, the rental returns are going down,
Yes.
the various tax breaks are getting a little bit less, and if Labor comes in, it'll be even more so. So there seems to be a fundamental shift in the mindset of many property investors at the moment.
Very much so.
And I guess it's all part of this same conversation, because if you are wrestling with how do I make this property turn a profit for me, right? Because previously it was all about capital growth, wasn't it?
That's correct.
Right. So almost never mind what rental I can get, because I know if I sit in it for 5 years, I'm going to be significantly better off. Whereas now we can't say that anymore.
That's exactly right.
Right.
And now we've got all these added pressures.
Yep.
So we've, from 1999 in New South Wales and 1998 in Queensland, we got deregulation of the building industry. So private certification, in other words.
Right.
So from there, and since 2012, 2013, I've been blogging about the effects of what that caused, that deregulation caused. And I've been talking about the Sydney going into a huge oversupply of property, but not only a huge oversupply of property, of well-built property, but rather under-engineered property.
Right.
Hi, and welcome once again to Oz Real Estate TV. My name's Edwin, and I'm joined by Jennifer Duke from Property Observer. Welcome.
Nice to be here today.
What we're going to talk about is Sydney's $1 million ghettos.
It's a bit of a scary topic and a pretty good headline. What's that about?
Well, Jennifer, it's about the dangerous liaisons that I believe property managers, selling agents, and strata managers have with property developers. Now, we're actually at one of the major developing areas, Mascot, here in Sydney, where you've got $1 million apartments, or apartments being sold for close and on to $1 million and plus for the 3-bedroom penthouses. But yet, there's a lot of rectification work that needs to be done to these buildings, and they're only a couple of years old.
And you just walked me through one of them just previously, and it was pretty shocking. What sort of damage have you noticed?
Well, we've got waterproofing issues, settlement cracks, render coming off, peeling away from the main walls. Now, we're not talking about something that you could put a step ladder on and then fix it. We're talking about scaffold going up 4, 5, 6 levels in order to rectify. We've got concrete cancer. The foundations as well have in some areas have sunk noticeably, to the point where you've got large amounts of water coming through to the basement car park areas.
And it's only in the last few years that the mainstream have been talking about the cladding, the issues, but it goes even further than that, Martin. It goes a lot further than that. It goes to the point where cladding, you can rip that out and you can replace. It's going to be costly for the investor, for the owner, or owner-occupier or investor. It's going to be very costly. Yes, I agree. But how do you rectify sub-basement issues? How do you rectify the foundational issues?
Yep.
You know, you can't rip up your neighbouring property so you can inject concrete down 3, 4 levels down, 20 metres down because of the basement car parking. Because guess what? You've got another high-rise building next to you. You've got another one behind you, and you've got another one on the other side. So you've got all these issues. So as you were saying, You've gone from 90% of investors no longer looking at buying. I don't blame them. And the ones that have bought are now, in their minds, I'm sure all these figures are ticking because the strata levies have gone from $750 a quarter to $2,500, $3,000. And by the way, here's a notice for a special levy of $35,000 per dwelling per unit, because we now have to raise $5,000, $6,000, $7,000 to rectify, not solve, just temporarily rectify the issues that have now come to being.
Right. So that's important, because what you're saying is it's not just the older properties, right? Even the more recently constructed ones potentially have issues because they've been thrown up with relatively minimum standards, or maybe even people going around the standards, to an extent. So effectively, even there are still risks in the portfolio too.
Very much. I've been questioning and I've been asking various government officials, why have they allowed for properties or for high-rise development in Parramatta to go 5 basements down? It's a floodplain, for crying out loud.
Yes. Yeah.
If you look at the older buildings in Parramatta, this is just one of the many areas that I've looked at. But if you look at the older buildings in Parramatta, most of them, they barely went down a basement, half a basement, because of that reason.
Yep.
And then the car park was on top of road level. So you had maybe one basement and 3 levels above street level.
Yep.
And then you had the dwelling on top of that. But now all of a sudden, because of developers and underhandedness, unfortunately, well, you got all these shifts and changes. Everybody started digging deeper. I'll give you an example. There in Parramatta, not too long ago, you on 1,000 square metres, you could only build 25 apartments. Now on 1,000 square metres, you can go as high as 110.
Yep. Yep. No, I understand. At a time when supply is already extended, and there are lots of partly built. So how's this going to play out then? So if you think ahead over the next 5 years, there's not going to be a huge amount of capital growth, is there?
No. We're seeing negative equity.
Yeah.
So the banks now have to consider negative equity.
Right. Okay. So lack of capital growth, negative equity, oversupply, existing property stock looking a bit flaky in places. This sounds like a bit of a disaster.
From what I've seen play out, even though I've said to a number of my colleagues, and I am a lot more bearish than what they are. As you can imagine, most real estate agents are still somewhat bullish in a lot of areas.
Just a bit.
Just a bit. But even I have been shocked as to how quickly all this is playing out. I think I tagged you on one of my tweets where our good friend Mr. Cookie, Mr. Cookie Man, he sent me a private message, and he said, "Look at this price of this apartment in Blacktown." Now, I quickly had a look at it, looked at RP data and also other figures that I've got from other agencies and sales and so forth, and our own, and I saw the falls from where, even in the office that I'm currently working at, we sold an apartment on the other side of the railway line, similar floor plan. It must have been the same builder or the same architect, if not the same builder, the same architect that designed these blocks. But the one in a better street has just recently sold for $320,000. The one that we sold in January this year, we sold for $420,000.
Yep.
How is it going to play out?
Tells you something. Yeah. And presumably this isn't just a Sydney thing, right? So, we can pretty much assume that there are similar stories going on in the other urban centres around the place.
Very much. Look, it's as I say, I look at the Blacktown LGI very, very carefully because of the makeup, because of the demographics, the diversity of cultures, the diversity of dwellings, the many generations that live in the Blacktown LGA. and also because it's perhaps one of the biggest LGAs in all of Australia in terms of geographically. So it encompasses a lot. It encompasses properties that are worth $300,000 to properties that are worth $1.6 million.
Yep.
And so I've looked at it, and hence the reason why I say this is the canary in the coal mine. So that somewhat reflects the greater part of Sydney. And then again, what I've seen is plays out because construction is not that much different in Melbourne as it is in Sydney as it is in Brisbane.
Yeah.
The tablelands are pretty much identical as well. And the issues that my colleagues and other people and other articles that I read from other people that speak about the industry, they all seem to come across the same thing. Digging too deep, foundational issues, water seepage, strata levies going through the roof, properties being under-engineered. I've blogged, I've posted, I've videotaped some of the construction that's gone on in Sydney, and it's no different to what I've seen in a lot of the other states. What I do recall is that from the previous downward turn in 2004, 2005, it's deja vu, similar scenarios. Yeah, back then, Sydney's getting too expensive, let's go and buy in Queensland, let's go and buy in Melbourne. And then all the frenzy goes and happens in Queensland or Brisbane and in Melbourne, or the outskirts of Brisbane and Melbourne, and because it's cheaper. And then there's an upward trend there, and it seems to last a bit longer than Sydney. But then when it starts to fall, it falls a lot quicker than what Sydney does.
Yep.
It's just a historical trend, and I don't think this one's going to be any different. Other than, as I've said many a times, it's going to play out, and it's in terms of it's going to play out for a lot longer, and we could see the carnage, as I refer to it, is going to be 3-4 times as big than the previous one.
And I guess, I've been surprised because I've been predicting for the last 2 or 3 years that there's going to be some downturn. But the rate at which prices are falling, the rate at which credit growth is beginning to shrink, and therefore the impact is much more immediate than I expected.
Yes, and it as I said, it's caught me by surprise as well.
Yeah.
And I'm all over this every day, day in, day out, talking to people, getting figures, doing this, doing that, apart from my daily stuff as well, because I enjoy it. And it is somewhat frightening.
Yeah.
And if I'm somewhat startled by it, I could only just imagine what the banks and the banking industry is going through right now.
Well, it's interesting because there were a couple of reports in the week about people adjusting their expectations, right? NAB's survey came out and they've actually forecast now a bigger drop. Not a very big drop, but a bigger drop. Morgan Stanley came out this week and said, well, we think prices will be 10 to 15% lower, right? Now, both of those organisations a few months ago were actually much more bullish than they currently are, right? And it seems to me that every time they come back with another view, it's more and more negative.
Yeah,
right?
well, it was only February, March this year where you've got some of the mainstream again that have been very critical of yourself and that have blocked me on Twitter. I don't know why. Go figure. They were talking 5 to 8% growth.
Correct, yes. Earlier in this year, a number of people were still saying prices will be higher. Yep.
Go out and buy.
Yep.
Go out and
Yep.
cumber yourself, because we're still going to. The banks are still going to print money, and we're going to.
Yep.
It's party till it's 1999 or 2000, whatever the print song was.
Yep.
But it's turned around so quickly,
Yep.
and hence the reason why it's becoming scarier.
And it's interesting that even the New South Wales government this last week said they think that migration should be slowed so that effectively there's a chance to sort of adapt a bit more compared with where we were previously. So even now at the state level, there's an expectation perhaps of less migration rather than more migration.
I'm glad that a lot of this is playing out because the tenants are now going to be a lot better off.
Yeah, a bit
They're
more.
going to be in much better dwellings, and they're going to have a smorgasbord to choose from.
Yeah. So it seems to me that there is silver lining here, right? There may be a chance now to begin to think a bit more strategically about what we should be doing, right? And to think differently about the way we plan our infrastructure and how we actually manage our portfolio of properties, right? I just hope that that is something which actually the state government in particular does grasp, rather than just sort of accepting the stamp duty and just merrily carrying on, right? But we'll see. I'm not I'm not holding my breath.
We'll see. And I guess the other question that needs to be asked is, once again, is what are the international investors that are holding on to these vacant dwellings, the 140,000 or so? What are they going to do when they get a notice from the owners corporation to say that now they've got to raise a special levy to do all the rectification work, and it's in the tune of $25,000-$35,000.
Yeah. When the capital value is not going up.
Exactly. So I think they're saying to themselves, well, we can, and again, the reasoning for a number of them to park their money here in Australia, different to, they didn't want capital growth, they didn't want capital return. It was really just more so to park their money for fear of getting it taken away in their states. So, but comes a point where even they're going to say, how much do I really want to lose?
Yep.
30%, 40%, 50%. Yep. But it's not only, remember, they bought the money out.
Yep.
Now, how do they bring more money in to pay for the rectification?
Yep.
In theory, and I say in theory, a Chinese national can only take out of China $50,000 over his or her lifetime.
Yep.
Out of China.
Yep.
I think they've gone over that quota, many times over. And so when they get a notice to say, hey, we need 35, 45,000, what are they going to do?
Yep.
For sale.
Yep. Yep. So it sounds to me as though this sector of the market is in for a bumpy ride.
It's an interesting ride. It's going to be a very interesting, bumpy ride.
Yep. And I'll tell you just as we close, it's very interesting that when I talk to through my surveys to property investors, right, there are about half of them who have no idea what their overall returns are, right? And a lot of them are now saying, I'm not sure I want to know. It's better not to know, because actually we might be, seriously surprised on the downside. So it's interesting. But I still think it's worth getting to grips to understand and then make some decisions. Edwin, thank you very much. It's been great talking to you again.
Pleasure to talk to you, and hope to see you another day, another time.
Yeah, no, let's do this again sometime.
Cheers.
Good, thank you. So there you go. It's very important to think about property portfolios and the types of property that you have if you're an investor. And remember that in a flat or falling market, the decisions that you may want to take may well be different. I'm Martin North from Digital Finance Analytics. Many thanks for watching. If you like what you've seen here today, please share and like the post, add a comment or question. I read them all. And please don't forget that you can support our efforts via Patreon. The link is below. Thanks for watching. See you next time.